For the latest in strategic affairs, subscribe to our YouTube channel. Click the bell icon for more updates.
Did you know that the Indian economy was ranked 13th in the world in 2000-2001? Today, it is number 5. Did you know that in 2000-2001, India's per capita income was $442? Today, it has grown five-fold to $2,600. Hello and welcome to another edition of Capital Calculus. I'm your host Anil Padmanabhan. Last week, the Central Statistical Office put out the official estimates for India's GDP or gross domestic product for 2023-24. It was a shocker, a pleasant one at that. It revealed that India's rate of growth of GDP in 23-24 will be a very, very impressive 7.3%, taking the size of the economy to 3.6 trillion by the end of March. A few weeks earlier, the Reserve Bank of India said something similar. In its latest credit policy review, it raised the growth forecast from 6.5% to 7%, while maintaining inflation at the same levels that it had projected earlier, implicitly suggesting that the surge in growth or the increase in growth will not come about at the cost of inflation. Independently, Axis Bank put out a similar forecast. They said all of these things and something more. According to Axis Bank, India was poised to enter a new growth trajectory, one that is 7%, not the 6% previously. The latest numbers suggest that Axis Bank may actually be on the money. Indeed, this happens, it's going to be a game changer. For one, it will accelerate the ongoing makeover of the Indian economy. Just to give you one example, the target of 5 trillion set for 2030 will happen much earlier if this growth trajectory is maintained. To unpack all this and more, we spoke to the chief economist of Axis Bank, Neelkanth Mishra. Neelkanth is one of the most astute observers of the Indian economy and also a member of the Prime Minister's Economic Advisory Council. I began by asking Neelkanth about this new growth prospects for India. Was he surprised?
I was not. In fact, I have been saying for a while that the recovery post-COVID is going to be better than what most people think. And the fact that India's trend growth assumptions had been brought down too low. If you recall, in 2011-12, everyone thought that India would grow at 8% a year without any stimulus or so through the cycle the trend growth was going to be 8%. As the decade progressed, we found that those numbers were reduced. So if you recall, people had started bringing down to about 6.5% or maybe less than that as well. And then there was this fear that because of the scarring in the economy post-COVID, that we would see an even lower growth rate. In fact, as we entered FY24, there were people with growth forecasts of 4.8. And I was of the view that growth looks like it will be well above 7. And so it has played out like that. And that's actually, to me, it's not surprising because the capital investment cycle is now starting to turn. And we can dip into that if that's of interest. But I think on both sides, real estate, which was in India, is emerging from a 10-year downturn, as well as the private sector capex, where the deleveraging is mostly over, and we haven't invested in several sectors. Just to end the point and to summarize it, see, there are three parts to GDP growth, right? So there is labor input, there is capital input, there is total factor productivity growth. Labor input, to a large extent, is very steady, predictable. How many workers are joining the workforce is more or less known. How many years of education they have is also somewhat smooth. Total factor productivity growth can be volatile, but over a 5-year period, the diffusion of technology, the buildup of infrastructure, those things make things a bit more steady. The cyclicality comes from capital formation, the pace of capital input, and that had slowed down substantially by 2019. In fact, it had fallen to the levels last seen in the late 90s. So now we are seeing a pickup in capital formation, and therefore I think trend growth assumptions will get bumped up to about 7% or so.
So, obvious follow up, Neelkanth, is India on the growth turnpike in that case?
It is so compared to, and on a relative basis, even more so. So the real estate cycles in Germany, in the UK, in US, of course, very famously in China, have been very strong and robust for many decades. In some cases, 2.5 decades, like in Australia, and now they're starting to turn down. And when that happens, of course, the overall economy. So one of the reasons that Germany is struggling and is possibly already in recession is not just the high cost of energy and the problems with their manufacturing, but it's also about a turn down in the real estate sector. In India, that's a very important sector. In fact, we had estimated that the downturn in the real estate sector had been a drag on growth of more than 1% a year between 2012 and 2019. So the fact that that drag is over means that growth starts to pick up.
Now, while Neelkanth has given us logic and evidence about his optimism, but still, I was dogged by this fear of deja vu. India is flattered in the past to only deceive. So, why would this time be different?
No, it's a very important question. We need to be very cautious when we make these projections. And so if you look back, so actually the growth disappointment it really hit us after 2012. It was 2008, of course, in the global financial crisis. I think the India was one of the outliers in terms of not having seen a very bad impact. And that was because of this massive increase in the pay commission salaries, which damaged our fiscal condition. So by 2012, it was looking clear. And to be honest, I used to get very frustrated around that time that everyone said, oh, we'll grow at 8%. I said, look, 8% growth is not a given. You need to continue reforming, you need to be very disciplined. And if you looked at the balance sheet of India around that time, it was looking very stretched. So this is what I call the balance sheet model of forecasting. That you can be running at a certain pace, but or you can be driving a car at a certain pace, but are your tires burning out? Do you have fuel in the tank? Is it that you've already run a marathon? Can you run another one? And that's where the state of the body, the state of the economy, the balance sheet of the economy becomes very important. In 2012, we were starting to incur very high current account deficits. We were starting to have very high fiscal deficits. The leverage levels in many business groups was just going out of whack. I remember my colleague and at CS we had put out this House of Debt report where we looked at the 2012 balance sheets, and 8 out of those 10 companies and 10 groups don't exist anymore. So banks had actually gone on a limb and had lent too heavily. If you look at the situation today, it couldn't be more different. So our net international investment position, while it is still negative, as a percentage of GDP, has corrected quite a bit. We have assets to equity ratio in the banks and the non-banks at very low levels, meaning that they are very well capitalized. So if there is a demand for debt, I think they are very well positioned to service that. And the corporates, partly because of the fear that was induced by the insolvency and bankruptcy code and the fact that no one was left untouched, or very few people, I mean, the largest of business groups lost assets, has meant that everyone started to deleverage. And we have deleveraged too much. So we are starting to see now that we need new capacity, like in power, for example. I mean, in October we hit the peak load, and for the first time in many years, we had to see power cuts. So, so the balance sheet side looks far better than it did in 2012, even though the growth rates at that time were higher. And that makes me think that and that the risk of a significant disappointment is much lower. I wouldn't say that there is no risk of disappointment. Remember that the global environment still remains very choppy. Export growth of both goods and services is still slowing. My fear is that a lot of what is happening in the US, the positive growth surprises, is driven by a fiscal stimulus. In fact, in the first 2 months of this fiscal year, October and November, for the US, their fiscal deficit is up 14% year on year. Right. So, and people keep celebrating that, oh, look, there is no recession in the US and every forecaster was wrong. Yes, every forecaster was wrong. But the costs of that fiscal stimulus, even if it's unintended, are going to show up at some point, and that will drive a much steeper correction in external demand, and that's going to be very bad. So I think some of those concerns are there, which is why we think that FY25 growth rates is likely to slow. So we can be growing below trend at maybe at a 6.5% rate in FY25.
Okay, so Neelkanth, one key link in this story of recovering growth is the private investment. So far, government investment is literally pulling the growth trajectory, which is not sustainable because of two reasons. A, fiscally, you cannot fund it. Secondly, the proportion of government investment in total investment is very negligible. So, this gorilla in the room, you did signal that you're seeing some trends, incipient trends. How hopeful are you that private capital investment will finally take off?
Correct. So it should have started recovering in 2019-20, but then COVID hit because there were lots of shocks to the economy, lots of corrective measures between 2015 and 2019, including RERA and insolvency and bankruptcy code, and then demonetization and introduction of GST. So they were very disruptive. In fact, one phrase I used to use at that time was India is a house under construction, right? So there will be mess, there will be dust around, you will struggle. Was why did we do this? We were happy with the old home, and it's only when the new build starts and when the new build ends that you actually get some comfort and clarity on what the growth trajectory is going to be. So no, I think that the private sector capex, see, the private sector capex is driven by uh, many variables, but two primary variables, right? The first is where is utilization. So if the utilization is at 70%, and the second variable is, of course, what is your expected growth rate, and this expected growth rate is 6%, then you say, you know what, I have enough capacity to fund the next 5 years, and so there is no urgency to do capex right now. But then you see, say, utilization going to 75%, and your trend growth assumption goes from 6 to 7, and you say, oh God, now only have 3.5%, 3.5 years of spare capacity left, and therefore I need to start investing because it'll take 2 years, 2.5 years to bring capacity up, and what if growth surprises even more? And then one or two companies in an industry do that, and the rest of the country companies then say, "Oh God, they are investing. We'll start losing market share." So they start investing, and that investment itself then triggers an acceleration in GDP growth, and then it sort of keeps. This is why economic cycles occur, right? Which is why you'll never see a very smooth trend in economic growth unless you're China. The And we are starting to see signs of that. So for example, you see, you know, uh, year-on-year growth of 10-12% in cement, and companies really have to rethink whether they need some capacity 3 years out or 5 years out, and they need to start planning for that. And the moment they start planning and investing in that, some of their competitors start to respond, and that investment itself then supports growth. So I think we're at the early stages of this reversal, uh, where the deleveraging cycle. Like, think about power, right? Power is a very classic example. So thermal power capacity. There was a time in 2008, 9, 10 when our thermal power capacity was about 130 gigawatts, and we were at that point in the process of adding 200 gigawatts of thermal power capacity. Now, that means that your GFCF, the gross fixed capital formation, the broadest measure of investment in the economy, was at a very high level. And then it could only correct because that was unsustainable. Similarly, in steel, we had 45 million tons of steel capacity, and we were at that point constructing 60 million tons of steel capacity. Now, even if it takes 4 5 years to build, it shouldn't take that long, but it used to. This will create overcapacity for many years, and this is exactly what happened, right? So many, steel, of course, also suffered from China, but in power, we saw utilizations dipping below 60%, and many of the power plants just became unviable, and so they had to go bankrupt. Now, what we are seeing is that after 8 9 years of almost no investment in thermal power, we are now starting to hit the limits. Now, power is a sector where demand tends to be very volatile, meaning there is an average plant load factor utilization, and then there is a peak plant load factor, which is utilization, which is sometimes 10 12% higher than what the average is. So in October in last year, we actually hit the peak PLF at the ceiling, and therefore there were blackouts, and short-term power tariffs just went through the roof. I think we could hit that again in March when the heat waves restart, and pre-election all states will not want to give blackouts. And so guess what happens? Some of these thermal power plants will become very profitable, and then all investors will start jumping into it. The last gold rush in thermal power was because one power plant, and you will remember which one it was, had delivered its had returned back its capital investment in 1.5 years. Remember, these are 25-year projects, or these plants last 25 years, and this one plant had delivered its cost of capital within 1.5 years, and that led to a massive gold rush. And I'm not saying there'll be a gold rush again. It shouldn't be, because thermal power has its you know end use date. But I wouldn't be surprised if in March April we see another wave of projects starting to come through.
A striking aspect about the growth forecast by RBI and Axis Bank is that it will not stoke inflationary pressures. Why?
Okay, so inflation is when you start growing above what your trend growth is, and it occurs because your demand is overshooting supply, and it generally occurs when your either monetary conditions are too loose, or your fiscal deficit is expanding rapidly, right? So, and see, both of these are effectively borrowing growth from the future. Uh, right now, we have you know fiscal deficit dropping, and it is if the government sticks to its target of 4.5% by FY26, we will see continued consolidation going forward. And MPC has kept interest rates very high, and so real rates are now after a while in positive territory, and we are also seeing uh, very tight liquidity conditions, so that credit growth is effectively capped. So with these kind of liquidity conditions, you can't grow credit anymore, which means that now companies will have to start rationing out credit. So the economy, when it is running like that, it is very hard to see core inflation accelerate. There is a third factor there, which is that the the economy is still about 1.2 years behind where it should have been if COVID had not occurred. So there are, as we measure the recovery post COVID, the first level, of course, is whether you cross the pre-COVID level of GDP of output, which we did very easily because we are growing much faster. But even today, we are 1.2 years behind where we should have been if COVID had not happened. In that sense, we have now caught up to the world. So the world saw a much faster recovery, but that was primarily because of massive fiscal stimulus in the US and Europe. We didn't give any, or we didn't give too much. And so now we've caught up. So the world is now slipping away from the pre-pandemic path, but we are now catching up to the pre-pandemic path. But we are still 1.2 years behind, which means that on critical things like labor, there is still a lot of surplus available, which is why you are seeing that labor still does not have pricing power, which is why you're not seeing uh, demands for massive wage growth across the economy. And so those are the reasons why I think this growth acceleration, which is where the bump up in trend growth assumptions is a much stronger statement that if you keep growing at 7, you're not going to see core inflation pick up. But at the same time, we need to be very cautious on the food side.
It was in 2004 that Vijay Kelkar, the then advisor to the finance minister of India, told a room full of investment bankers in New York that India was poised on a growth turnpike and they should look very favorably towards India. Indeed, his prophecy did hold true. For the next 5 years, India's growth took off at unprecedented levels. In fact, in 1 year it clocked 10%. But all of this came crashing in 2008, which is why a feeling of deja vu when once again we speak of a growth turnpike for India. However, all the key stakeholders, whether they be the Union Government, the Reserve Bank of India, private analysts, and global investors most of all, believe this time it's different. Evidence seems to support their optimism. A happy convergence of physical, social, and digital infrastructure has created the ability for India to do public good at staggering scale, lifting 415 million people out of poverty in 15 years, banking 511 million Indians in a span of 10 years, is just a few examples that I'm sharing with you. Clearly, millions of Indians can ready for better times to come, or what some called Achhe Din. Fingers crossed though. Thank you for watching. Don't forget to subscribe to StratNews Global on YouTube. Hit the bell icon so that you don't miss any updates. And please do share your thoughts, ideas and suggestions. I'm available on Twitter at Capital Calculus. I'll be back next week with another episode. Till then, stay safe.